Welcome to Economics. Today, we will make a brief explanation on financial markets by taking a close look on what are financial markets, the types of financial markets, and some of the financial instruments. What do we mean by market risks, and what are the best ways to approach financial markets? And finish with a review on the topics. So, what are financial markets? Imagine a big marketplace where people buy and sell different things. In the financial world, this marketplace is called financial market. But instead of buying and selling your favorite phone or car, people here buy and sell financial instruments such as stocks, bonds, commodities, derivatives, and so on, in hopes of getting a future return. But it also constitutes an important way to raise capital and liquidity for big companies. Some of the financial market participants include banks, investors, governments, institutions, and individuals like you and me. So, what are the types of financial markets? First, we need to distinguish between primary and secondary markets. Primary markets are where securities are sold for the first time, such as IPO, initial public offering, where companies issue stock for the first time. But the most known markets are the secondary market, where previously issued securities are bought and sold among investors on a daily basis. Stock markets. The most well known of financial markets are the stock markets, where shares of companies are bought and sold by traders and investors. Stock markets are a key way for companies to raise capital and for investors to seek returns. Some of the biggest stock market is the New York Stock Exchange, an index which comprehends over 2,000 stocks both from the USA and foreign stocks. Bond market. Bonds are agreements between lenders and borrowers, in which the borrower or the bond issuer has the obligation to pay a fixed interest amount on pre-established dates to the lender, who is the bondholder. Bonds constitute a way for corporations or governments to finance activities and represent a secure instrument to investors to receive their promised returns. Derivative markets. The world of derivatives is vast and complex, but the main idea is that their value derives from an underlying asset, which can be bonds, commodities, currencies, interest rates, stocks, and so on. An example of derivatives are future contracts, which are contracts that oblige the buyer to purchase or the seller to sell an asset at a predetermined future date and price. To make things simple, take for instance a farmer who worries about his wheat future price, and a baker who needs wheat but worries about future price fluctuations. In this case, both arrange a future commodity contract in which the farmer agrees to sell a specific quantity at a specific price and fixed date. There exist two scenarios. If the wheat price goes up after the specific date, the baker benefits as it's getting the wheat at a lower price than what it costs currently in the market. And second scenario where the prices fall down after the date, in which the farmer wins as it gets to sell at a higher price than what it's sold currently in the market. In this way, both seller and buyers assess future price risks. Forex market, being the largest and most liquid financial market in the world where participants buy and sell currencies. Contrary to other markets, forex markets operate 24 hours a day, 5 days a week. It helps facilitate international trade and manage currency risk. Commodities markets, where raw goods or primary products are traded, categorized into hard commodities like gold, oil, or agricultural products like wheat, and soft commodities such as sugar, cocoa, or coffee. And it plays a crucial role for risk management of the price of commodities. One of the most known commodity markets is the Intercontinental Exchange. Cryptocurrency markets. In the most recent years, cryptocurrency has become increasingly popular. Cryptocurrencies are virtual decentralized currencies which operate without intermediaries. One of the most known virtual currencies are Bitcoin. But fraudulent activities surrounding these assets and its high imposed risks are shifting opinions on whether these virtual coins constitute good assets to hold in portfolios. Now, what do we mean by financial risks? One of the key aspects when diving into financial markets is the capacity to assess risks. On general terms, risks refer to potential adverse outcomes that participants can face due to various origins. One of the many common risks involved when operating in the market is market risk, which is the potential loss of an asset value due to market price fluctuation. So, what are the best ways to operate in the financial market? Certainly, there is no clear answer to that, as there is no magic formula that will guarantee you future returns. But it should be noted that having a clear strategic plan with set financial goals and a nice planned diversified portfolio to assess risks and staying constantly informed will always give you an edge when approaching financial markets. So, to conclude today, we have seen that financial markets work similarly to normal markets, in which the product being sold are financial instruments. We distinguished between primary and secondary markets and took a look into different financial markets such as the stock market, the bond market, the derivatives market, forex market, commodity market, and cryptocurrency market. We defined market risk as the potential outcome of an asset to lose its value due to price fluctuations, and that a structured financial plan, diversified portfolio, and being constantly informed will always give you an advantage in the market. Thank you for watching. I hope you liked the video. See you in upcoming content from Okonomics.